On the evening of November the 22nd, 1910, a private rail car departed from a station in Hoboken, New Jersey. Its destination was a hunting lodge on Jekyll Island off the coast of Georgia. The passengers used first names only, some used aliases. They had been instructed to arrive separately and to avoid being seen together. They carried no luggage that would identify their affiliations. The men aboard that rail car represented approximately 1/4 of the total wealth of the entire planet. Among them were Abraham Piatt Andrew, Assistant Secretary of the United States Treasury; Henry P. Davison, Senior Partner of J.P. Morgan and Company; Benjamin Strong, Head of J.P. Morgan's Bankers Trust; Frank Vanderlip, President of National City Bank, the largest bank in America at the time; Paul Warburg, partner at Kuhn, Loeb and Company, representing European banking interests, including connections to the Rothschild financial network; and Senator Nelson Aldrich, chairman of the National Monetary Commission and father-in-law to John D. Rockefeller, Jr. These men spent 9 days on Jekyll Island drafting a document. That document became the blueprint for the Federal Reserve Act, signed into law on December the 23rd, 1913. The institution they designed, the Federal Reserve System, would go on to finance both sides of global conflicts, facilitate the largest wealth transfers in human history, and operate with a level of autonomy that no elected body has ever been able to fully penetrate or audit. This is not the part they teach in school. What follows is the financial architecture beneath the wars, the documented, traceable flow of money from private banks to sovereign belligerents, and the returns those banks collected while millions died on the terms their capital had underwritten. The relationship between private banking and warfare is not speculative. It is the oldest documented financial arrangement in Western civilization. The Medici Bank financed the wars of Italian city-states in the 15th century. The Fugger banking family of Augsburg underwrote the Habsburg Empire's military campaigns across 16th century Europe. But the modern architecture, the system in which private banks do not merely lend to governments at war, but actively shape the conditions under which wars become financially necessary, began with 2 families and 1 institution. The Rothschild banking dynasty, established by Meyer Amschel Rothschild in Frankfurt in the 1760s and expanded by his 5 sons across London, Paris, Vienna, Naples, and Frankfurt, created the first truly international private banking network. Their innovation was not financial products, it was information asymmetry. By operating across national borders during the Napoleonic Wars, the Rothschilds had access to intelligence about military outcomes before governments did. The most documented example occurred on June the 18th, 1815, the Battle of Waterloo. Nathan Mayer Rothschild, operating from London, received news of Wellington's victory over Napoleon a full day before the British government. According to accounts documented by historian Neil Ferguson in his work, The House of Rothschild, Nathan used this advantage on the London Stock Exchange. The precise mechanics remain debated, whether he sold consoles to create panic before buying at the bottom, or simply purchased immediately upon receiving the news. But the outcome is documented in the financial records. The Rothschild family's holdings in British government bonds increased dramatically in the period following Waterloo. They had financed Wellington's campaign, they profited from his victory, and they established a template that would be replicated at increasing scale for the next 2 centuries. To understand why banking and war became structurally intertwined, consider how sovereign war financing is supposed to work. A government faces a military threat. It needs to mobilize forces, purchase weapons, feed and transport soldiers. These costs exceed normal tax revenue. The government issues bonds, borrowing from its citizens and from financial markets, with a promise to repay with interest after the conflict. Investors buy these bonds because they trust the government will survive and honor its debts. The interest rate reflects the risk, higher rates for less certain outcomes. In this textbook model, the bank is a neutral intermediary. It facilitates the bond issuance, takes a commission, and moves on. The government bears the risk of defeat. The bondholder bears the risk of default. The bank earns a fee. This model assumes a critical condition, that the bank has no strategic interest in whether the war occurs, how long it lasts, or who wins. The moment a bank has a financial position that benefits from the war continuing or from a specific outcome, the neutral intermediary model collapses entirely. And the historical record demonstrates that this collapse has been the norm rather than the exception. The first anomaly in the historical record concerns J.P. Morgan and Company's role as the exclusive purchasing agent for the British and French governments during the First World War. In January of 1915, 5 months after the war began, the Morgan Bank was appointed by the British government as its sole commercial agent in the United States. This role gave Morgan control over all British purchasing of American war materials, munitions, food, raw materials, and equipment. The commission structure entitled Morgan to a fee of 1% on all purchases. Between 1915 and 1917, British and French war purchases through Morgan totaled approximately $3 billion. 1% of $3 billion is $30 million in 1915 currency, equivalent to roughly $800 million in today's terms. But the commission was the smallest part of the arrangement. Morgan simultaneously arranged loans to the Allied powers. In October of 1915, Morgan organized a syndicate of over 61 American banks to issue a $500 million loan to Britain and France, the largest foreign loan in American history to that point. The loan paid 5% interest. Morgan banks held significant portions of these bonds in their own portfolios and earned underwriting fees on the remainder. The structural conflict is arithmetic. J.P. Morgan and Company was earning commissions on war purchases, interest on war loans, and underwriting fees on war bonds, simultaneously. Every month the war continued, Morgan's revenue increased. Every escalation in the scale of fighting increased the volume of purchases flowing through Morgan's account. The bank had a documented, quantifiable financial interest in the war's continuation and expansion. This is not interpretation. It is the ledger. The second anomaly involves the pressure applied to the United States government to enter the war. In 1916, the Allied powers were struggling financially. Britain's gold reserves were depleting. France was approaching its borrowing limits. If the Allies lost or negotiated a peace that did not include full repayment, every loan Morgan had arranged and every bond Morgan's syndicate held would be at risk. The total American financial exposure to the Allied cause exceeded $2 billion by early 1917. A German victory or a negotiated peace that did not fully satisfy Allied debt obligations would have caused catastrophic losses across the American banking system. In February of 1917, Germany resumed unrestricted submarine warfare. In April of 1917, the United States declared war on Germany. President Woodrow Wilson, who had campaigned in 1916 on a platform of keeping America out of the war, reversed his position. The conventional historical narrative attributes this reversal to the submarine campaign and the Zimmerman telegram. The financial narrative notes that the United States' entry into the war immediately transformed Allied debt from risky wartime lending into obligations backed by the full military and economic power of the United States government. The bonds held by Morgan's syndicate went from speculative to virtually risk-free overnight. Following America's entry, the United States government itself began lending directly to the Allies through the Liberty Bond program, ultimately extending over $9.5 billion in loans. The private banking exposure was effectively socialized, transferred from private bank balance sheets to the American taxpayer. Morgan's loans were repaid. The risk disappeared. The commissions continued. The third anomaly concerns the financing patterns of the interwar period and their connection to the Second World War. Under the terms of the Treaty of Versailles, signed in 1919, Germany was required to pay reparations of 132 billion gold marks, equivalent to approximately $33 billion at the time. Germany could not pay. Its economy was devastated. In 1924, American banker Charles Dawes, a Morgan associate, proposed a plan that restructured Germany's reparation payments and opened the door for massive American lending to Germany. Between 1924 and 1930, American banks, led by institutions within the Morgan and Rockefeller networks, lent approximately $3.3 billion to German entities, including German municipal governments, industrial firms, and infrastructure projects. This lending served a circular function. American banks lent money to Germany. Germany used a portion of these funds to make reparation payments to Britain and France. Britain and France used reparation receipts to repay their war debts to the United States, debts originally arranged through Morgan. The money flowed in a circle, and at every stage the banks collected interest and fees. When the global depression struck in 1929 and American lending to Germany stopped, the entire circular system collapsed. Germany defaulted on its reparations. Britain and France defaulted on their war debts. The German economy imploded. The political vacuum created by economic devastation enabled the rise of the National Socialist Party. The banks that had created the circular lending structure bore no legal liability for the geopolitical consequences. Their loans were written off as losses offset against profits from the preceding boom years. The human consequences: the Second World War, approximately 70 to 85 million dead, do not appear in any bank's ledger. The fourth anomaly involves documented financing of both sides of conflicts. The Rothschild network's historical practice of maintaining banking relationships across opposing national lines is well established in the historical record. During the Napoleonic Wars, different branches of the family maintained relationships with both French and British authorities. This pattern continued into the 20th century through successor institutions. During the 1920s and 30s, American industrial and financial firms maintained commercial relationships with German entities that continued even as political tensions escalated. Standard Oil of New Jersey, controlled by the Rockefeller interests, maintained a partnership with the German chemical conglomerate IG Farben through a joint venture called the Standard IG Company. Ford Motor Company operated manufacturing facilities in Germany that continued production into the war years. International Business Machines, IBM, supplied tabulation equipment to German government agencies. Chase National Bank, part of the Rockefeller banking network, maintained its branch in occupied Paris throughout the war. These relationships are documented in corporate archives, government investigation records, and the findings of the Senate Subcommittee on War Mobilization, chaired by Senator Harley Kilgore in 1943 and 44. The subcommittee found that American corporate relationships with German industrial firms had facilitated technology transfer that strengthened Germany's war capacity. None of these findings resulted in criminal prosecution. The corporate entities involved continued to operate and to profit after the war's conclusion. The fifth anomaly concerns the structural incentives embedded in war financing that persist to the present day. The United States defense budget for fiscal year 2024 exceeded $880 billion. The defense industry is dominated by 5 primary contractors: Lockheed Martin, Raytheon Technologies, Boeing, General Dynamics, and Northrop Grumman. These companies are publicly traded. Their shares are held by the largest institutional asset managers, BlackRock, Vanguard, and State Street, which together manage over $20 trillion in assets. The same asset managers hold dominant positions in the largest banks: J.P. Morgan Chase, Bank of America, Citigroup, Goldman Sachs. The same banks serve as primary dealers for United States Treasury bonds, the instruments through which war is financed. The same Treasury bonds are purchased by the Federal Reserve through monetary policy operations. The circular structure, in which the institutions financing government debt are the same institutions profiting from the expenditures that debt finances, is architecturally identical to the Morgan Arrangement of 1915. The scale is different. The mechanism is unchanged. The sixth anomaly is the documented pattern of financial market movements preceding major geopolitical events. Academic research published in the Journal of Financial Economics and other peer-reviewed publications has identified statistically significant patterns of unusual options trading activity in the days preceding major geopolitical announcements. The most extensively documented case involves the trading activity before September the 11th, 2001. The Securities and Exchange Commission investigated unusual volumes of put options, financial instruments that profit from a decline in stock prices, purchased on the shares of American Airlines and United Airlines in the days preceding the attacks. The investigation concluded that the trades were made by investors with no connection to the perpetrators and reflected market speculation rather than foreknowledge. This conclusion was contested by several independent researchers, including Professor Alan Poteshman of the University of Illinois, whose statistical analysis, published in the Journal of Business, found that the ratio of put-to-call options on American Airlines was exceptionally high by historical standards on the trading days immediately preceding the attacks. 2 interpretive frameworks organize these facts. The first framework is coincidence and structural inevitability. Banks are in the business of lending. Governments are in the business of spending. War is the most expensive form of government spending. Banks will inevitably be involved in financing conflicts because they are the mechanism through which large-scale capital is mobilized. The profits they earn are the standard returns on financial intermediation, not evidence of war engineering. Corporate relationships across national lines reflect globalized commerce, not collaborative belligerence. Market anomalies before geopolitical events reflect the aggregate intelligence of markets pricing in publicly available risk factors. The second framework follows the financial architecture. The institutions that profit from war are the same institutions that advise governments on foreign policy. The banks that financed the First World War applied pressure through loan conditions, financial exposure, and political relationships to ensure the United States entered that war. The lending structures created after the First World War directly contributed to the economic conditions that produced the Second World War. The revolving door between financial institutions and government policy roles ensures that the perspectives of capital are permanently embedded in strategic decision-making. The evidence distinguishing these interpretations is partially accessible. Congressional investigation records from the Nye Committee hearings of 1934, which investigated the munitions industry's role in America's entry into the First World War, are publicly available in the National Archives. The Kilgore Subcommittee records documenting American corporate relationships with German firms are similarly archived. Morgan Bank correspondence from the First World War period is held in the Morgan Library and Archives. The Federal Reserve's own history, published on its website, acknowledges the Jekyll Island meeting and the role of private bankers in the institution's design, though it frames their involvement as public-spirited expertise rather than self-interested architecture. The international dimension of this pattern extends beyond any single nation's banking system. The Bank for International Settlements, established in 1930 in Basel, Switzerland, was created specifically to manage the flow of German reparation payments. During the Second World War, the Bank for International Settlements continued to operate, facilitating transactions between central banks of nations that were actively at war with each other. The Czech gold incident of 1939, in which gold reserves belonging to Czechoslovakia were transferred to Germany through the Bank for International Settlements with the cooperation of the Bank of England, remains one of the most documented examples of financial institutions operating above the level of national allegiance. The Bank for International Settlements exists today as the coordinating body for the world's central banks. Its meetings are private. Its deliberations are not published. Its governance is not subject to any national legislature. The International Monetary Fund and World Bank, established at the Bretton Woods Conference of 1944, were designed in part by representatives of the same banking networks that had financed both sides of two world wars. The architects became the regulators. The financial infrastructure that connects private banking to sovereign conflict has not been dismantled. It has been refined. The raw mechanics, loans, bonds, commissions, fees, remain identical to those documented in 1915. The institutional relationships between banks, defense contractors, asset managers, and government agencies have become more concentrated, not less. The 6 largest American banks today hold combined assets exceeding $14 trillion. They serve simultaneously as primary dealers for government debt, as lenders to defense corporations, as holders of defense company equities through their asset management divisions, and as advisors to the same government agencies making procurement and foreign policy decisions. The question this analysis cannot resolve, because no publicly available document resolves it, is where the boundary lies between financing war and facilitating it, between profiting from conflict and incentivizing it, between serving a government's needs and shaping those needs to serve the bank's interests. The historical record demonstrates that this boundary, if it exists, has been crossed repeatedly by documented actors in documented transactions with documented consequences measured in millions of lives. What the historical record does not demonstrate is that any institution, any regulator, any legislature, any international body has ever successfully enforced that boundary for more than a single generation before the same patterns reassert themselves in new forms, with new names, through new instruments, managed by the institutional descendants of the same networks that gathered on Jekyll Island in November of 1910 in a private rail car using assumed names to design a financial system whose operations remain, over a century later, only partially visible to the governments it was ostensibly created to serve.